Every investment, whether good or bad, teaches us lessons. In this video, I talk about the lessons for we investors from the largest Ponzi scheme in the world. Yes, I'm talking about Bernie Madoff, and for all those who don't know him, he executed the largest Ponzi scheme ever in the history by defrauding thousands of people of over tens billions of dollars over 17 long years. Incidentally, he was also the chairman of Nasdaq in 1990s. In 2009, he was sentenced to 150 years of prison, and as of December 2018, the Madoff Victim Fund has returned over $2.7 billion to the affected investors. Would it be great to learn from what seemed like a legitimate practice from a legitimate company? I really thank CFA Institute for the content of this video. The first thought that came to my mind was, don't mistake sales pitch to due diligence. Even today, there are lingering thoughts about Madoff's feeder funds. How could you miss a scam like this? Was there any due diligence at all? How can you compartmentalize bad due diligence? I mean, if an industry like this can't spot such big a fraud, how do you expect us to spot changes in style drifting or exodus of fund managers? It is therefore imperative and important that investment fund managers actually look for red flags by continuous monitoring and good due diligence. But just like the way they missed Madoff's treacheries, I'm sure investment managers who have this arrangement of pay to play, whereby they allow the client's money to be managed by outside fund managers, will miss the future trends of mediocrity while the clients pay. I mean, think over it. The second lesson that I learned is that Madoff used exclusivity as a bait. Many investors were literally begging or queuing up to enter into the Ponzi scheme, and so were wealth management firms. One fund manager famously said, the perpetrators of this scheme make the target feel special and above average, and therefore they are entitled to special high rate of return. I'm not at all saying all the fund houses are bad, not at all. All I'm saying as a lesson from Madoff is that if there is exclusivity, it is a red flag for investors and investment managers like us. The industry would far fare better if we focus more on transparency and not so much on exclusivity. Does unit-linked insurance plan, ULIP, ring a bell? Think. Third important lesson is, don't believe in numbers. Madoff numbers were all bogus. So were his transactions, and the compelling headline numbers were all fake. Now I draw the parallel to IRR, internal rate of return calculations. These are legitimate mainstay of wealth management industry, often compelling and sometimes deceptive. Now I'm not saying IRR is fake. All I'm saying is the issue with IRR is that it considers all the distributed income over the distributed rates at the same IRR, which cannot be the case, right? I mean, how can the money lying in a savings account grow at the same rate as your growth mutual fund? Not possible, right? So when you're looking at investments, delve a little deeper, ask tougher questions about calculations of returns. I'm repeating, calculations. At one level, the lessons from Madoff scam serves investors and financial professionals alike. They flag importance of investment pitches that need further scrutiny. And for finance professionals like us, they illustrate the importance of transparency and thorough and simple to understand explanations. But on another level, these three lessons teaches us the importance of investing in simple, transparent investments. Investments that are not exclusive. The world around you is investing, thereby wetting it every day. As long as the dividends and any other cash flows are invested back into the fund, a simple annualized return should do the trick for you. What you see is what you get. And I'm sure you don't need anything more than that. Thank you for watching this video and hope you like it. See you.